Welcome to the channel. Today, you'll learn about 5 trading methods that use volume profile. By the end of this video, each of these methods will become a valuable addition to your trading arsenal. We'll go through each strategy, break down real trading examples, and show you how to find entries, set stop losses, and define realistic targets. But before we start, a quick note for new viewers. We've already covered all the key terms and tools in a separate video tutorial. You'll find the link to that guide and to the EURUSD trading platform in the description. The first setup focuses on trading high-volume nodes. In simple terms, the peaks of the volume profile. Let's take a look at the Euro chart from early November, with the cumulative volume profile displayed on the left. When the price revisits these peaks, traders watch for potential reversal signals, expecting that strong buying or selling activity at these levels will influence the next price move. You can also use the periodic volume profile to focus on volume peaks within specific time frames, like a day or a week, helping you align your strategy with recent price action. To successfully apply this strategy, pay close attention to how the price behaves as it approaches a high-volume peak. Look for confirmation signals like candlestick patterns, volume spikes, or reversal signals from other indicators. Now, let's expand our analysis and see how the profile develops. This is the end of the first trading day, November 1st. Notice how the profile evolves and high-volume areas start forming as peaks. We can identify one peak, followed by a second, then a third and fourth. The highest peak marks the price level where the most volume was traded. The next day opened with a gap. You can see how the price bounced off the last candles, creating a break. As we extend our analysis, it becomes clear that volume is building up here, making this high-volume node even more significant. The very first candle of the day added to the volume, pushing this peak up to the second most prominent level. As we incorporate more candles, you'll see this entire area strengthening. Now I'll draw a horizontal line at this peak and another at the second one. This suggests that when the price revisits these levels, the market is likely to react. As we expand the analysis, this peak remains a key level. Now we're waiting for the price to return to this area, where I plan to go long, expecting a bounce off what looks like a strong support level. It's important to remember that these peaks don't always lead to an immediate bounce. The price often consolidates around high-volume zones. At times, it may seem like nothing is happening, and you might have to sit through a brief range. But don't let that discourage you. This is a typical behavior of high-volume nodes. Sooner or later, the market reacts, and that's when the trend starts to develop. Here's the Euro chart for the current week. You don't need to go far back in history or search for a textbook example to find a trade at a high-volume node. We'll use the weekly periodic volume profile for this setup. Right away on Monday, a high-volume area started forming, and the price quickly moved away from it. I'll mark this level with a horizontal line and wait for the price to return. If I spot a familiar pattern confirming an entry, I'll take a short position. You can also set an alert at this level to get notified when the price gets close. As you can see, the price doesn't always return to these areas right away. It can take some time. The price has just hit the level I'm watching, so I'm ready to open a short position here. But for now, I'm waiting for a trigger to confirm that the market sees this level. I'll look for the first candle in the direction I want to trade. In this case, a negative candle. This candle closed in red, in the lower half, which gives a negative signal that aligns with my trade direction. Now it's time to calculate the target based on the stop loss to get a 2-to-1 risk-to-reward ratio. I'll use the built-in short position tool in EURUSD. The stop loss is set at 19 ticks, so my target will be 38 ticks. We always calculate the target mathematically, but alternatively, you could target the fair value gap or, for example, an order block, which we can highlight here using the smart money concept. If you're interested in the concept of smart money, we'll leave a link to previous videos in the info card. I'll go with the order block but still aim for the 2-to-1 risk-to-reward ratio. I've set the stop loss at the high of the signal candle and the target here. Unfortunately, I didn't enter right at the close of the candle, so my risk-to-reward ratio is a bit worse. Let's turn off the volume profile for now so it doesn't distract us from the price action. And here it is, the price has hit the target. The position is successfully closed. The second setup is based on trading during volume dips or low-volume nodes. The LVN breakout strategy is a dynamic approach that focuses on spotting volume drops on the profile. These levels indicate a lack of interest from market participants, creating a potential breakout opportunity. When the price nears an LVN and breaks through it, traders often see a surge, as there are fewer orders to absorb buying or selling pressure. This can lead to quick price movements, making breakouts an attractive entry point. To effectively use this strategy, traders can rely on the periodic volume profile, which helps identify low volume areas across longer time frames. While watching how the price behaves around low volume nodes, it's also important to look for confirming signals, like a rise in volume or specific candlestick patterns that point to a breakout. Let's take a look at the current Euro chart. I have the monthly periodic volume profile shown here. I'll draw horizontal lines where the trading volume was lowest, marking volume dips. Now, let's zoom in a bit. The price hasn't yet returned to the first level, which would be perfect for our setup. But when it did hit the second level, there was a brief hesitation above it, followed by a candle forming in the direction we were looking for. This would have been a great entry for a successful trade. We could have entered the position at the close of this breakout candle, placing a stop loss above the swing high and targeting the classic 2-to-1 risk-to-reward ratio. Here the price came back to fill the fair value gap, so we could enter at the close of the FVG to average our entry price. Looking at how the market developed further, we see the price return to another low volume level from the previous month. This was followed by a range, but after a while, there was another strong reaction. This is how trading around low volume nodes works. For our second example of trading a low volume node breakout, we have the S&P 500 chart with the monthly periodic volume profile. The lowest volume of the month occurred here. This area represents the point of least trading activity from the previous month, making it a really interesting zone. Let's draw a horizontal line to mark the potential reaction at this low volume level. Now let's zoom in a bit and wait for the price to get closer to the level. The price has broken through this level, so we're now watching to see if the candle will close above it. Let's go long and calculate the risk-to-reward ratio with a 2-to-1 target. We'll place the stop loss just below the low of the breakout candle. The stop loss is 34 ticks, so our target will be 68 ticks. The position opened just below the breakout candle's close, but we stick to our stop loss and target based on our calculations, not when we entered. The price has just tested the level from above and is now moving steadily toward our target. Done. The next strategy focuses on reversals at the POC, point of control. This is a key technique that centers around the price level with the highest trading volume during a specific time period. This level, known as the high volume node, represents the point of greatest interest for traders. When the price approaches the POC after a dominant trend, it often signals a potential reversal. To effectively use this strategy, you can apply either the cumulative volume profile or the periodic VP. For this example, we'll use the periodic volume profile with daily volume. The main strategy for trading the POC involves trading at an untested level. The volume profile creates an untouched POC, which stays untested until the price comes back to it for the first time. If the price returns to a newly created POC from above, it can be seen as support, giving traders an opportunity to go long. On the other hand, if we extend the analysis to the first test of the POC, we can see that it was tested by these candles and acted as resistance, providing an opportunity to go short. If the price enters a range around the POC, it invalidates its status as an untested level. However, if I extend another POC and notice a few candles testing it, it could be a signal for a long position. Similarly, if another POC remains intact and is eventually tested, it gives us another opportunity to enter a trade. Another way to spot the POC is by creating a volume profile over a specific area. For example, when the price returns to the POC and stays in a range for a while, I can use the market profile drawing object. Let's turn off the periodic volume profile for now so it doesn't distract us, and use the drawing object. By applying it to this range, we can see where the POC level is located. When the last candle tests the POC level and closes positively, meaning it closes above 50% of its range, we can enter a long position. I would place my stop loss just below this level and either set a mathematical target or identify an interesting spot on the chart that could be tested. For example, I notice a fair value gap here that could serve as a target, so I'll set my stop loss below the entry point and close the position at that target. Now let's look at how to trade an untested POC in practice. Using the daily periodic VP, we can see the POC has yet to be tested by the price. In this case, we can use the indicators feature to enable extend to the first touch for the maximum volume parameter in market profile and TPO, so we don't have to manually draw horizontal lines. Now we're waiting for the price to return to the POC. As you can see, these candles have tested it. Next, we're waiting for the entry trigger. I'm planning to use the rain pattern, which we've already covered in our video series, so make sure to check the link in the info card. To confirm, let's switch to the footprint display and see how the candle closes. The candle closed below the POC level, so let's check the delta. The candle closed in the expected trade direction, red for a short. This gives us our entry signal, closing below the POC, delta confirming the short, and a completed auction at the swing high. We'll enter the trade one tick below the POC of the signaling red candle, taking a short position. The stop loss will be placed at the swing high, which is 27 ticks, so the target will be set at 54 ticks. Let's zoom in on the chart and get ready to execute the trade. And just like that, the price has hit the target. If we don't want to stick strictly to the 2-to-1 risk-to-reward ratio, we could consider other targets. For example, we could aim for another fair value gap. Closing at the FVG would give us a better risk-to-reward ratio, around 2.26 in this case. The fourth strategy is trading within the value area range. This strategy focuses on the price range where about 70% of the trading volume takes place. When the price moves into or out of the value area, it can signal potential trading opportunities. For instance, if the price breaks above the upper boundary of the value area, known as the value area high, it's worth looking for signs of a reversal or trend continuation. That if the price drops below the lower boundary, called the value area low, it could signal negative sentiment, suggesting a possible short trade. Let's continue with the Euro chart and activate the weekly periodic profile. In its settings, we've only displayed the VAH and VAL levels. Like with the POC strategy, the VAH and VAL levels aren't relevant until the price tests them. The profile needs to close, and the price must return to these levels in the next profile, in this case, next week, before we can trade them as support or resistance. The main idea behind the strategy is to look for VAH and VAL levels that haven't been tested by the price. The next condition is that the profile closes for the set period, and then the price tests the VAL/VAH levels during the next profile segment, in this case, during next week. Once the price returns to these levels, we can trade the reaction as we would with traditional support or resistance. Now, let's consider another way to trade VAH and VAL, since the price doesn't always react immediately when it reaches these levels. As the new week begins, the price sharply rises above the value area high, leaving the untested value area low below, which we plan to trade. I'll mark this level with a blue horizontal line so we can track the reaction. Interestingly, a similar setup is forming at the VAH, but for now, I'll focus on trading the VAL before coming back to the VAH. I'll also mark the VAH level with a horizontal line and turn off the volume profile since it's not needed for my entry trigger. Now, as the price approaches the VAL, you can see there's no reaction suggesting that this level might act as support. Instead, the price breaks through sharply and closes below it. While we could consider a breakout trade, we'll take a different approach. We're looking for a pullback to this level from below, or we'll trade it as a flip when a previously broken support level turns into resistance. The price sliced through this level without hesitation, as if it wasn't even there, so we'll wait for a retracement from the other side and look for a short entry instead of a long. If a short entry trigger appears, we'll take it. I'll use a simple method again. Switching to a footprint chart and waiting for a candle to close in the direction of the trade, red for short positions. The candle should close below its POC. For now, though, the POC of this candle is still at the top. The candle has just closed at its POC level, which works for me since it hasn't closed above the point of control. Now, let's set up the trade. The short entry is planned at this candle's close, with a stop loss above its high and a standard 2-to-1 risk-to-reward ratio. With a 26-tick stop loss, my target is set at 52 ticks. The fair value gap could also serve as the second target. And the first target was hit on the very next candle. Now let's see if the price can reach the second target by filling this FVG. While it's not a strict rule, in this case, the price did hit the second target on the wick of this red candle. Now, let's revisit the VAH setup we put on hold earlier. Here's last week's VAH level. You can see how these candles broke through it. For a trade trigger, let's use a simple rule. There should be a candle that closes in the direction of the intended trade. In this case, we don't have one, there's no red candle or a candle that closes below 50% of its height, a negative candle. That makes taking a short position here too risky. However, we could consider a long entry on the breakout. Notice how we're seeing the same flip scenario again, the price has returned to this level from above. Instead of acting as resistance, it's now turning into support, creating a potential long setup. This is a great example of how value area levels and their reversals can be used to identify trading opportunities. The trend confirmation strategy. Using volume profile is a powerful tool for confirming the strength and direction of a trend. By analyzing price movement relative to the value area, traders can gain insight into market sentiment. If the price consistently holds above the value area during an uptrend, it signals strong positive momentum and increases the likelihood of the trend continuing. However, if the price stays below the range in a downtrend, it suggests negative sentiment and a higher probability of further decline. Let's demonstrate this strategy using a crude oil chart with high volatility. The main idea is to observe how the volume profile changes compared to the previous profile. Here we can see that both the value area high and value area low have shifted lower. This indicates that focusing on short positions makes more sense, as going long would go against the trend suggested by the volume profile. As we continue analyzing, we notice that VAH and VAL have dropped further, strengthening the case for looking for short opportunities. However, if we see a day when these levels move higher than the previous value area, it could signal a potential trend reversal. As I keep watching the price action, I'm still focused on potential long opportunities. I'm waiting for a pullback before entering a long trade. However, the situation could change. If we see another VAH and VAL setup where VAH moves lower, I'll wait for a pullback and consider opening a short position. This is the key idea of using volume profile to confirm trends. It helps determine the preferred trading direction for the day by observing how the value area evolves, and whether the highs and lows of the profiles shift. This enables me to open positions in line with that direction. In this chart, we'll show how to use the evolution of the volume profile to enter trades in the direction of the trend. After a downtrend, there's a significant upward shift in the value area of the profile. This strong movement suggests that the market might be gearing up for a reversal, which signals a potential opportunity for a long position. Looking at the previous day's profile, I can spot a few interesting areas. There's a high volume node, which I'll mark as HVN, and an important low volume node. These two areas are crucial for tracking how the price reacts. Since we're currently below the HVN, it might not be the best time to enter a long position. However, earlier, there was an opportunity to go long when we saw a positive candle closing above 50% of its range, forming a pin bar. If I aim for a gap here, the risk-to-reward ratio would be around 2.5. This could be our first trade. Now that we're ready to open long positions, let's wait for a reaction at the low volume node. As the price approaches this level, notice something important: none of these candles close below the low volume node. Even though one wick dips below it, none of the candles close beneath it. This gives us another entry signal. I'll focus on the close of this green candle, as it suggests the market is likely to move upward. I'll set a stop limit by order using the long position tool. My entry will be just above this candle, with a stop loss at its low, 39 ticks away, and a target of 78 ticks for profit. I also see an interesting level on the chart where the recent price action broke through the low. I'll mark this level, expecting the price to test it at least once. This trade could offer a better risk-to-reward ratio than 2-to-1, but I'll stick to aiming for 2-to-1 and see if the price reaches my second target. Now I'm in the position. I've set my stop loss at the low of this candle and my target is planned. To wrap up, keep these two key tips in mind. Focus on one or two strategies that suit you best and practice them on just a couple of instruments instead of trying to master everything at once. Make sure any level you plan to trade hasn't been tested yet, and use additional triggers to confirm your entry points. Thanks for watching, and best of luck with your trading.